A major, profitable corporation filed its tax return last year. Record profits. The effective tax rate was 11%. The average worker in that same country paid a higher rate. Both filings were completely legal. That gap is not an accident. Here is a comparison most people have never actually seen side by side. The statutory corporate tax rate in the United States is 21%. That is the rate written into law. But the effective rate, what large corporations actually pay after every legal deduction, credit, and strategy is applied, is often significantly lower. Multiple studies analyzing the financial filings of the largest publicly traded companies have found that a meaningful number of profitable corporations pay an effective federal tax rate in the single digits. Some years, some companies have paid effectively zero on billions of dollars in profit, legally. Meanwhile, the average worker in the same economy pays income tax that is automatically withheld from every paycheck, with very limited ability to defer, shift, or restructure that liability. This is not a story about corporations breaking the law. Every strategy involved is explicitly written into tax code, court precedent, or international agreement. It is a story about a tax system that was built with tools specifically designed for entities operating at a scale that almost no individual taxpayer ever reaches. By the end of this video, you will understand exactly how these tools work, why they exist, and what the gap between statutory and effective rates actually reveals about how tax policy gets written. Let us start with the mechanism that makes the largest difference. The single largest tool available to multinational corporations for reducing tax liability is called profit shifting. Here is the basic mechanism. A corporation operates across multiple countries. Different countries have different corporate tax rates. Some jurisdictions, historically including Ireland, the Netherlands, Luxembourg, Bermuda, and several others, offer significantly lower corporate tax rates than larger economies like the United States or major European nations. A multinational corporation can structure its internal operations so that profits are recorded in the lower tax jurisdiction, even when the actual economic activity, sales, customers, employees, occurs primarily in higher tax countries. One of the most well-documented techniques for doing this is called transfer pricing. Here is how it works in simplified form. A corporation's subsidiary in a high-tax country sells a product or service. That subsidiary pays a licensing fee, royalty, or internal charge to a related subsidiary in a low-tax country, often for the use of intellectual property, like a brand name, patent, or software platform. The high-tax subsidiary's profit is reduced by the amount of that internal payment. The low-tax subsidiary's profit increases by the same amount. The total profit of the corporation has not changed. However, where that profit is taxed has shifted dramatically. Tax authorities require these internal transactions to be priced at what is called arm's length, meaning the price should reflect what an unrelated third party would actually pay. In practice, valuing intellectual property like a brand name or a patent is extremely difficult to pin down objectively. This ambiguity creates substantial room for corporations to set internal prices in ways that legally minimize their overall tax burden while remaining within defensible interpretations of arm's-length pricing. Research by economists studying this phenomenon has estimated that profit shifting moves hundreds of billions of dollars in corporate profit annually into low-tax jurisdictions globally, profit that would otherwise have been taxed at significantly higher rates in the countries where the actual economic activity took place. This is not a fringe practice used by a handful of aggressive companies. It is a standard, widely used strategy among the largest multinational corporations in the world. And it requires international operations, sophisticated legal and accounting infrastructure, and scale that simply does not exist for an individual taxpayer or a small domestic business. Profit shifting across borders is only one piece of this. Domestically, the tax code contains an entire category of tools that function similarly, reducing taxable profit through legal mechanisms that are disproportionately useful to large, capital-intensive corporations. Start with accelerated depreciation. When a business purchases major equipment, machinery, or infrastructure, the tax code allows that cost to be deducted from taxable income over time, reflecting the asset's gradual wear and use. Accelerated depreciation provisions, including bonus depreciation rules that have been expanded at various points in tax law, allow corporations to deduct a much larger portion of that cost in the early years of an asset's life, sometimes the entire cost in the first year. This dramatically reduces taxable income in years when major capital investments occur. A corporation that regularly invests in large equipment, facilities, or infrastructure can use this provision year after year, consistently reducing its taxable income relative to its actual cash profit. An individual taxpayer, whose primary expense is typically labor and consumption rather than capital equipment, has no equivalent tool available. Next, consider net operating loss carryforwards. If a corporation loses money in one year, it can carry that loss forward to offset taxable profit in future years, sometimes for an unlimited number of years under current law. This means a corporation that had a difficult year, perhaps due to a one-time event or a strategic restructuring, can use that loss to reduce or eliminate tax liability on profits earned years later, even after the company has returned to substantial profitability. This provision exists for legitimate economic reasons. Businesses genuinely do experience volatility, and taxing only net long-term profitability makes economic sense in principle. But large corporations with sophisticated tax planning capacity are positioned to use this provision far more strategically and extensively than a small business or an individual ever could. Then, there are targeted tax credits, incentives written into law for specific activities like research and development, renewable energy investment, or domestic manufacturing. These credits are often most accessible to corporations with the scale to invest heavily in the qualifying activities and the specialized tax expertise to properly document and claim them. Each of these tools, taken individually, has a defensible policy rationale, encouraging capital investment, allowing businesses to smooth profitability across cycles, and incentivizing research and clean energy. But the cumulative effect of stacking accelerated depreciation, loss carryforwards, targeted credits, and international profit shifting together is a tax system where the largest, most sophisticated entities have access to a toolkit that shrinks their effective rate far below the statutory rate, while ordinary wage earners, whose primary income has no equivalent toolkit, pay close to the full rate written into law. If seeing how these tools stack together changed how you read a corporate earnings report, stay with me, because understanding the mechanisms is one thing. Understanding who actually wrote these provisions into law and why they have survived decades of public criticism without major reform, that is what comes next. And it follows a pattern you have likely seen before on this channel. The provisions we just walked through did not write themselves into existence. They were drafted, debated, and passed by legislators. And the drafting process for complex tax legislation relies heavily on input from the industries that will be affected by it. This is a structural feature of how tax law gets written, not a secret conspiracy. Corporate tax departments, industry associations, and specialized tax lobbying firms routinely submit detailed technical feedback during the legislative process, explaining how proposed provisions would affect business operations, and often proposing specific alternative language. This input is not inherently improper. Legislators genuinely benefit from understanding the practical effects of complex tax provisions on businesses that will have to comply with them. But the volume and sophistication of this input is wildly unequal. Ordinary taxpayers do not employ specialized tax attorneys to review proposed legislation and suggest specific statutory language that would benefit them. Large corporations and the industries that represent them do. The lobbying expenditure data on tax policy specifically consistently shows that industries with the most at stake in specific provisions, finance, technology, pharmaceuticals, energy, spend enormous sums ensuring their interests are represented throughout the drafting and passage of major tax legislation. The 2017 Tax Cuts and Jobs Act in the United States, for example, reduced the statutory corporate rate significantly and included numerous provisions that benefited specific industries in ways that were extensively debated and documented by independent tax policy researchers in the years following its passage. Whether any individual provision was good or bad policy is a genuine debate among economists. What is not in genuine debate is the asymmetry of influence in how such provisions get written. Here is the rewritten text. The detail that makes this particularly durable as a structural feature rather than a temporary policy choice is the following. Once these provisions exist and corporations have built their financial planning, investment decisions, and even their corporate structure around them, removing them becomes economically disruptive in ways that generate intense, well-resourced opposition. This is the same pattern we have discussed regarding individual tax preferences in an earlier video. Concentrated benefit produces concentrated, well-funded defense. Diffuse cost, spread across millions of taxpayers, each individually affected by only a small amount, produces comparatively little organized opposition. The system does not require anyone to act in bad faith for this outcome to persist. It only requires the incentive structure to remain unchanged. And it has remained unchanged for a very long time. Actually, this changes how you read corporate financial news. First, it reframes how you read corporate financial news. When a company reports record profits alongside a low effective tax rate, that combination is not an anomaly to be surprised by. It is the predictable output of a system that consistently rewards scale and sophisticated tax planning. Second, it clarifies a comparison worth making in your own financial life. Calculate your own effective tax rate, total tax paid divided by total income, and compare it honestly to the effective rates reported by large corporations in their public financial filings, which are publicly available information. This comparison will not change your tax bill. However, it will change how you evaluate political and policy debates about corporate taxation when you encounter them. Third, and most practically, the same tax code that contains provisions favoring scale also contains smaller scale equivalents that individuals and small businesses can legally use. Forming a small business, even a modest one, opens access to business expense deductions, simplified depreciation rules, and retirement account options not available to a standard wage earner. These tools are smaller in scale than what a multinational corporation uses. But the underlying principle, that the tax code rewards owning and operating capital rather than simply earning wages, applies at every scale, including yours. The system favors structure. Building any structure, even a small one, changes your position inside it. The largest corporations in the world are not breaking the law when they pay a lower effective tax rate than you do. They are using the law exactly as it was written. The gap between the rate they pay and the rate you pay is not a glitch. It is the predictable result of a tax code built, provision by provision, with more input from scale than from ordinary wage earners. Now, you understand why the gap exists. And what, even at a smaller scale, the same underlying logic offers you. Share this with one person who has ever wondered why corporate profits and corporate tax bills do not seem to match. And if you want to keep understanding the systems built around how money actually moves, subscribe to Hidden Truth Files. Hidden, no more.